Welcome everyone to the Wealth Management Review for June 17th, 2021. The title of our presentation today is the Update on the Great Reopening. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me in a few minutes. A reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. We're looking at about a 30 to 35 minute presentation. This is actually a re-recording of our live webinar on Thursday, June 17th. So we want to thank City National Rockdale for the contributions and research done with today's presentation. Wealth management at Krug and Associates involves a lot of different things that we work on, investment consulting and many advanced planning strategies. Today, we're focused in on the wealth enhancement, how the economy and the stock market is performing. So our agenda today is the markets and the economy. Where are we at here in June? What are some of the latest developments? So we'll hop on now. Say hi to everybody. It's good to see you.
Well, hello, good morning, or good afternoon, or good evening. It may be in the middle of the night for you right now because this is a recording and you could be watching it any time that you want.
Right.
Rocky, we got a lot to go through today, so why don't we just go ahead and push right through. What I'm going to start with today is the markets and the economy. First thing I really want to talk about is the production ramp up that's going on right now. This chart shows you a 20-year history of the Purchasing Managers Index. And it's interesting because if you look at the gold dotted line, that's kind of the average over time. It's the 50-point mark. And sometimes you see it below, sometimes you see it above. But if you look over to the right-hand side, you can see that jagged downturn. That was your closing of the economy last year. And now what we're seeing is a rapid recovery in demand, which is pushing production. It's driving the production up right now. So hopefully, sometime in the near future here, we're going to have production and demand level out a little bit and give us some kind of, some normalcy is what I think everybody's looking for right now. Let's look at the record demand for workers right now. This is another interesting thing that's happening that's coming out of this close down of the economy. The total job openings are now way above pre-pandemic levels. And it's funny because if you look at the employment over the last year or so here, you can see that right now there's about 1.1 employed people per job opening versus the pandemic high of 5 in April of 2020. And this chart really kind of depicts the job openings and the small business hiring plans moving forward. And you can see that it's moving in the right direction. Certainly more productive than it was prior to the shutdown. And when you're thinking about the employment, you also have to think a little bit about wages and the increases in wages that are coming. And it's interesting, like everything else in this economy, there are certain areas that are booming in wage earning, and there's others that are kind of lagging behind. And the leisure and hospitality industry, which really got hit the hardest during the pandemic, is the area that the change in the average hourly earnings is moved the highest. So it's up about 5.5%. And you can go all the way through the different areas and all the way down to education and healthcare, where they're a little bit lagging right now. Average overall is still sitting at about 2.1%. So average is good, but you can see some areas are benefiting, others are lagging behind a little bit. Let's talk a little bit about inflation too. Inflation, you're hearing this in the news right now, that inflation is really rising, and it is short term. But if you go back to the pandemic, the inflation actually dropped 1.8% towards the beginning. And then as the recovery started and the pandemic kind of moved forward, you could see that inflation started to rise. It got to about 3.8%, which is that bar in the middle of the chart here. But the interesting fact here is if you take an average from February 20 to May 21, you'll find that the average is about 2.6%. Even though that is still higher than the Fed target of 2%, you can see that over the last year, a little bit more than a year, it's not what we would consider out of control at this point. So we are expecting inflation to stay a little bit high for this year, and that's being driven by really specific sectors. There are some sectors that there is a drop in inflation, it's gone negative. Other areas where it's really gotten kind of out of control. And let's kind of look at those areas. Think about your automobiles. For a long time, the automotive industry was shut down during the pandemic. And because of that, the supply that they had on the shelves was beginning to dwindle. And it got to a point where they now have parts that they can't get to finish the production of cars and trucks. Well, if you look at this chart on the left-hand side, you can see used cars and trucks, the prices have skyrocketed. Matter of fact, they've gone up about 30% over a year ago. So that's one area that is pushing inflation. The other areas you can see in the center where you have travel and leisure reopenings, transportation is increasing dramatically, hotels are increasing, and food away from home is increasing too. The only area that's really stayed a bit stable is your core services. It's not inflation all across the board, it's really targeted areas. Let's take a look at commodities also. Commodity prices and increases are reflecting the increase in demand as the economy recovers from this recession. And this chart here kind of shows you back to 2006 through the 2008 recession, what was going on with the commodity spot index, which really is an index of all commodities. In the recession of 2008, you can see that the commodities dropped dramatically. But as the recession ended and you started seeing people go back to work and people willing to buy again, you saw the commodity index really kind of move forward all the way to 2011. And then from there, it kind of sagged down all the way until we hit 2020 and again hit another recession where the index dropped initially, but now is running up again, just like it did after the 2008 recession. Now, that being said, we also expect that it's going to kind of roll over and start coming back down again. One of the areas that are in this commodity index is your lumber. And y'all know that lumber has gone up dramatically since this recession has hit. And ultimately, the price for the lumber had gotten to about $1,700 a 1,000 foot for lumber. And that is really kind of a record high there. But what we are already seeing is those prices coming down. Matter of fact, in September of this year, they're expecting that 1,700 to fall all the way down to below 1,000. And the future prices going out to the end of the first quarter of next year are already down to around the 600 level. Now, you have to remember, it started out before this recession started at about 586. So we still have some room to go to improve, but I don't think we're going to get back to that level again. But certainly it is improving as we move forward. If you're thinking about remodeling, if you're thinking about building a home, you might want to wait till next year because the prices are going to be a whole lot better. We're going to get into the latest developments, and I'm just going to give you a little bit of a summary here. First, As COVID restrictions drop, the economic activity is increasing in this post-pandemic boom. We're all seeing that right now. The global COVID situation still isn't good, but it is improving. And, you know, like you would expect, the international recovery is still lagging the US. There is a rapid increase in demand, and supply shortages are driving the rapid production increases at the same time. Now, there is a gap there, but it is moving to get everything restored and restocked on the shelves. And then the job growth improves. They do expect to continue adding about 2 million jobs over the next year to the economy. So that's good news moving forward. Inflation remains elevated, as we do expect the inflation to stay a little bit high through 2021, but it's not going to stay up there. We expect the Feds to really make some adjustments, make sure it stays on course. And there is an ongoing, unprecedented global monetary stimulus, which keeps interest rates really kind of at low levels right now. And it doesn't look like they're talking about stopping the stimulus, which is a little bit scary from a debt standpoint, but it is keeping the overall interest rates low. Let's go on to the next one. Market volatility is really being driven by inflation and interest rate uncertainty. Volatility in the market is where the opportunities present themselves. So there may be high valuations in certain segments of the market, but there are also other markets that are producing low valuations, and that's where the opportunity is. And that's where the institutional money managers really start shining, as they start rotating out of those high valuations into the low valuation segment. So overall market. That being said, we're going to move it over to Rocky.
Well, let's talk a little bit about what we're looking forward to in the next 6 to 12 months. What I like to show, and many of you have seen this before, but we want to keep bringing it up and seeing what's happening in trends in the economy, is these are 20 leading economic indicators that we follow on a daily basis to see where we think things are heading as we're planning to invest and where to invest. When you're looking at these indicators, there's 3 colors that we use to signify what's going on in that area. Green. The green dials represent that it's moving in a positive direction. The yellow dials represent that it's kind of neutral. It's not necessarily moving forward, but it isn't falling back either. And then red would represent negative. And as you can see here, as we came into June and we were looking at the indicators, we don't have anything in the red. We see a lot of green, a little bit of yellow, but overall the economy continues to look good for the next 6 to 9 months. All these things are very positive as far as what we see and what we're planning for moving forward in the economy. This chart is basically looking at what has happened in the past in previous bull runs in the first and second year. So if you look down the left side of the column, you'll see bull market start dates all the way back to 1970. If you go to the bottom, you see March 23rd, 2020. This is when we first had the first turn up in the market that signaled we were moving into a new bull market coming out of the recession from the COVID shutdown. And as you can see in the second column, the year one gain last year into March of this year, the S&P went up 72%. Now it was down 30-some% during COVID. So that was a lot of catch up, but it's moving forward in the right direction. The next column over is the year 2 gain. So what you'll notice is there is a considerable slowdown between the first and second year. However, those rates of return for the next 12 months historically have been very, very strong, double-digit returns in many cases. And we believe we're right in that 8 to 12% rate for this year. So we expect the second year of this bull run to be very good for stocks and for portfolios moving forward. The next columns over represent how many times the market pulled back 5% or 10%. So this growth does not come without volatility. So do expect to see some pullbacks in the market. We may be in one right now. We're down about 2 to 3% last week, and it's staying a little volatile. But this is very common in a second year of a bull run. You do not want to be out of the market during those times. This chart is basically talking with inflation and interest rates. So what happens when inflation starts to increase? The right side of the chart basically shows you that even with rising inflation rates, the market on average, that gold bar, has returned historically an average of 6.3% while inflation is rising. Now, when inflation is falling, 14.4%, that's a great return. But we're not there right now. That's where we were 5 years ago, falling interest rates. We are at a bottom, and those interest rates are going to start going up. And people's concern is, well, what happens when interest rates go up? Well, let's look at the left side of the chart and figure out historically what has happened. When you look at that first bar, the first blue bar that says less than 0%, when inflation is below zero or negative, the S&P gives you an annualized rate of return historically of around 20%. That's great return. Go to the next bar, 0 to 2%. So when inflation starts up but is relatively low at 0 to 2%, on average, historically, we've done 11.7% rate of return annually on the S&P. 2 to 4% inflation, 8.5% rate of return. So what that shows you is even inflation at 2 to 4%, you're getting a positive, almost 4% real rate of return over the inflation rate. So you are growing your money. Same thing when inflation is between 4 and 6%. You still have the opportunity to actually grow real money ahead of inflation. The only place we seem to run into trouble is if interest and inflation rates get above 6%. So when inflation is greater than 6%, that's a deterrent to growth in the stock market. It just is very difficult at that point to grow your money. However, when you look historically at bull and bear markets, bull markets run about 7 years and bear markets run between 18 months and 3 years. So it still pays to be invested. And what do you do when the rates of return are low? That's the time you buy, expecting the next bull market run.
Well, absolutely. And you also have the institutional money managers that absolutely take advantage of those dips in the market like that.
Right.
So recessions aren't necessarily bad. They can actually be your friend if you take that long-term view.
Right. And that's relating only to an index. So within the index, if you're looking at who are the winners and losers based on what's going on in the economy, just like they did during the COVID recovery, you can take real advantage of what companies are growing and given the returns to your portfolio. And that's what our money managers do. So this chart talks a little bit about what's going on with the negotiations with the Biden package to possibly increase taxes on corporations. And the chart, starting with the left side there in the green, is our base case scenario of if corporate tax rates go up from 21 to 23%, which is a high expectation, and the GILTI tax rate, GILTI stands for basically companies that are owned by the US companies, but are wholly operating in a foreign country. We still tax those foreign companies through their ownership in the US. And that rate is about half of what the corporate tax rate is here in the United States, or 10.5% is the expected base case rate. With those types of corporate tax rates, we expect the earnings per share in 2022 of the S&P to be around $209 per share. Okay, so that's still a great return, even though we expect taxes to go up. But what we wanted to show you is what happens if taxes get increasingly higher than where they're currently at. If you go to the alternative tax scenario 1, 25% tax rate versus the current 21, a 15% GILTI or a foreign tax rate, that $209 earnings will have a major hit in their earnings per share of $6 and $3, reducing the net earnings on the S&P of about $200 or 5% loss in growth in earnings per share. And the same thing when you look at the 28% tax rate with a 21% foreign tax on the foreign corporations. That same $209 will be reduced to $195 on earnings per share. So that has a big impact on where things will go in the future from a stock market standpoint. That will definitely be a headwind. And that's some of the things we wanted to just kind of recap based off of where we see things going in the next 6 to 12 months. So some of the headwinds we see coming, the global economic recovery is slower overseas than it is in the US, and it's mainly due to Europe lagging behind. So from a portfolio perspective, we are overweighting US and underweighting Europe. The high valuation suggests that long-term equity returns will slow and moderate. Again, we're in year 2 of a bull run, not year 1. So we are going to see that moderating of returns, but we still believe there's plenty of opportunity to grow your portfolio over the next 6 to 12 months. The challenging environment for investment grade fixed income moving forward, interest rates have only one way to go when you're at 0. And that's up. And that will have a profound impact on the current bond markets and the current bonds that are out there right now offering low interest rates. So what's going to happen in the future if rates increase, companies are going to have to offer new bonds at higher rates, which will devalue the current bond portfolios that are out there. That's something that we're watching and that we're tactically managing through this low interest rate environment. Also, what we just talked about on the previous slide, higher tax rates will impact earnings per share negatively up to an estimated 5, even up to 7%. So that's something else we have to watch. What industries are the multinational industries that have a huge, huge potential impact, both in corporate taxes here, but in foreign tax increases? What are some of the positives though? What are the tailwinds, the things that are going to push the economy forward over the next 6 to 12 months? It's going to be the continued strong consumer recovery, people going back to work, people getting a paycheck, and all the pent up demand from the previous year there. You couldn't buy, you couldn't travel, you couldn't do the things you wanted to do. That's going to drive the economy and growth in corporate revenues. Job growth is expected to continue to improve. Obviously, it's hindered a little bit by short-term labor supply issues, but over time, those things work out. So we believe that's a positive. Monetary policy remains very accommodative. The Fed has done a good job of keeping interest rates low so that companies can borrow and expand and get through the hard times and keep themselves in a position to ramp up through recovery. Fiscal spending continues to look strong as there's 2 infrastructure packages right now in Congress that will again pump money into the economy, and companies will need to ramp up to meet those infrastructure goals and needs. Earnings for the S&P we see are going to stay on track and in fact be record highs in 2021 and even possibly into 2022 as we move forward in this expansion. So that's where we're at overall, Dan. I think that we see a good positive market.
Oh yeah, we do.
Not without its problems, but
absolutely. It's really interesting because we hear so much in the news and on the radio and whatnot, and not all of it's all that good. But when you really look at the facts, so you look at the statistics, you look at the information that is given to us, it really shows a very nice picture from an investment standpoint. And I'm kind of optimistic over the next year and a half that we are going to be in a market that is going to produce some pretty decent returns for our clients. And again, our institutional money managers are just phenomenal. They do a great job of mitigating risk in the portfolios, as well as being very opportunistic and getting those extra returns out of the market.
Yep.
So let's kind of move forward here. And what I'm going to talk a little bit about is some opportunities. And one of the things that I find interesting is people will say, you know what, aren't you really concerned about the markets? You know, are we going to have a sell-off? And the reality is if you don't have a plan, I can see why you would be worried. But the reality is our clients have plans. We have strategies. We can implement those strategies based on the market conditions. So the market doesn't necessarily take us by surprise. It would if we didn't have a plan, but we do. So let's talk a little bit about that. When you think about what wealth management is, it kind of means a lot of different things to different people. We really kind of zeroed in at what wealth management really means to us. And it starts with investment consulting. Investment consulting is really managing the portfolios. It's being in the market to get the returns our clients need. And the reality is there's over 460,000 different advisors out there. And of those advisors, all of them work in the market somehow. They all work with investing. Some do it better than others. The reality is it's become commoditized out there. Most anybody can invest in the market today. Where do we differentiate ourselves? The advanced planning aspect of what we do. What is advanced planning? Advanced planning is wealth enhancement strategies. That's really taking and working in conjunction with the portfolio manager, doing tax mitigation, financial planning, cash flow, and liquidity planning. All those really enhance what the portfolios will do for our clients, and it ends up giving you a higher net rate of return. In other words, that which you can keep in your pocket. You take that and you work it in conjunction with wealth transfer strategies. You know, the clients that have worked so hard to build what they have, we look at it, estate planning, legacy planning, business succession planning, multi-generational planning. This is all designed to really keep more in your pocket, more of what you worked so hard for. And then you have wealth protection strategies. Our clients have worked hard. They've built up a nice estate. And what they don't want is for that estate to be taken away unjustly or unnecessarily. And that's where the wealth protection strategies come into play. Insurance analysis is critical. Critical illness is out there, so you want to make sure there's some kind of protection against that. Estate protections for estate settlements, making sure the estate is structured properly, having liability, risk mitigation. All this is things that we do, strategies that we employ to protect a person's estate. And then about a third of our clients work with charitable giving. In other words, again, they've worked hard, but they've been blessed. They want to give back. So charitable giving strategies are the way to do that. From there, what we do is we try to enhance those strategies so a client can either give more or save more in taxes while they're giving. So that's really what wealth management means to us. You know, you might say, tell me more. Well, at the end of the day, we have a nice YouTube channel that has all sorts of videos where you can take your time, you can peruse them at your leisure and get a whole lot of information. If you want to know about Roth conversions, we have a video just on that. If you want to know about the draw and let heal strategy, we have videos on that. And you can see how those strategies can really enhance what you're doing with the growth in your portfolio. So that brings us to an end, Rocky. So, you know, we say this all the time. You don't need to worry. We'll take care of you and your family.
And we'll take care of you. So enjoy your day. Thank you for attending. And
we'll see you at the next round.